Good morning, dear students. I'm Vipin Kumar and I'll be taking a subject for corporate financial management. It's a finance specialization paper for BCom students. Okay, we'll start with the term finance. The word finance derived from the Latin word finis and old French word fin for fine, which originally meant end. The French word for finance came to mean both payment and ending, but in the 18th century, the English adapted it to mean the management of money. Finance may be defined as an art or science of managing money, also is referred as the provision of money at the time when it is needed. Finance is considered as the lifeblood of business, and finance is the lifeline of any business activity. There are different occasions where we are using the term finance, and there are so many concepts like business finance, direct finance, indirect finance, public finance, private finance, corporate finance, and personal finance. We'll start with business finance. The business finance is that business activity which is concerned with acquisition and conservation of funds and meeting financial needs and overall objective of the business enterprise. According to Gutman and Duggal, it is defined as the activity concerned with planning, pricing, controlling, and administering of funds used in a business. So, the famous person Gutman and Duggal is defined the business finance in four components, mainly concerned with planning, pricing, and controlling and administering of funds. Finance function. The finance function refers to the practices and activities directed to manage business finances. The finance function in business refers to the functions intended to acquire and manage financial resources to generate profit. It produces relevant financial resources and information, contributing to the productivity of other business functions, planning, and decision-making activity. So finance function is nothing but how you are going to use the fund which you have already acquired from different sources and how effectively you will be able to redistribute the amount you have earned through the business. That is about finance function. Types of finance function. There are four important functions on finance, mainly financial decisions, investment decisions, dividend decision, and liquidity decisions. The next topic is approaches to finance function. There are two types of approaches, traditional approach and modern approach. So traditional approach says that the finance function related to initial stages of its evolution during 1920s and 1930s. According to this approach, the scope of finance function was confined to only procurement of funds needed by a business on most suitable terms. The utilization of funds was considered beyond the purview of finance function. It was felt that decisions regarding the application of funds are taken somewhere else in the organization. So this is the conclusion of traditional approach. The traditional approach only concerned with the rising of finance, from where you can rise the finance and which are the sources available for rising the finance. It only limited to that. So they are not even considering how they are going to use the fund which they have already collected. So that is about traditional approach. Modern approach. The modern approach views finance function in broad sense. It includes both the raising of funds as well as their effective utilization under the purview of finance. The finance function does not stop only by finding the source of raising enough funds. Their proper utilization is also be considered. The cost of raising funds and the return from their use should be compared. So unlike traditional approach, modern approach consider both pricing of finance and effective utilization of finance. Both are very, very important. How you are raising the fund from different sources and how you are going to effectively utilize the finance which you have already raised. Both are very, very important for modern approach. So they have given equal weightage for both of these functions. So that is about modern approach. Goals or objectives of finance function. There are four goals or objectives. First one, acquiring sufficient funds. Second one, proper utilization of funds. Third one, increasing profitability. And fourth one, maximizing the business concerns value. First point is acquiring sufficient funds. We know that every organization have to raise enough source of finance so that they can function well. They have to raise the finance for meeting their long-term requirement and short-term requirement. So they should ensure whether they are able to raise the fund sufficient for their short-term and long-term requirement. That is about acquiring sufficient funds. Second point is proper utilization of funds. Once the company which they have already raised the finance from different sources, where they are going to use the fund, how effectively they are going to use the fund, and whether it will give them adequate return to their investment. So these all problems are come under proper utilization of funds. Third one, increasing profitability. We all know that every business organization intention is to make profit. So how well they can improve the profitability and how effectively they can make profit, that is about the profitability aspect of every concern. For increasing the profitability, the company have to come with different ideas and innovative solutions for the same problem and innovative products, innovative services, etc., so that they can improve the profitability. So this thing is related with increasing profitability. Last point is maximizing the business concerns value. Ultimately, every organization have to give maximum wealth to the investors. So there are different stakeholders in an organization. So we have to satisfy the different people from different streets. Especially, we have to give maximum return to the investors, shareholders, etc. How can we give maximum return to the shareholders or investors? By making profit continuously and making very good returns in terms of dividend, in terms of capital appreciation, etc. to the investors in the long run, so that the value of the company will also improve after each year. So that is about maximizing the business concerns value.